When there's mass panic, which a bear market is extended mass panic, we see everything get liquidated. Whether it's a good investment, a solid company, gold, one of the, most solid, stable things, it still gets.
You're watching Silver News Daily. Subscribe for more.
Something historic is happening in the silver markets, and almost no one's ready for it. As the gold-silver ratio explodes past levels we haven't seen in a generation, traders are dumping silver in a panic. Prices are crashing. But what if this is the setup, not for silver's demise, but for its greatest rally yet? Think about it. In every major cycle where silver got crushed, it didn't just recover, it came back swinging with 3x, 4x, even 5x moves that shocked the markets. Right now, we're watching liquidation turn into desperation, with silver breaking below key technicals while gold hovers near record highs. It looks like silver's being left behind, but that's exactly when it starts to run. Because once the ratio stretches this far, it doesn't snap back slowly, it whips violently. And the traders who see it coming, they're the ones who catch the biggest moves. So is this the start of a devastating collapse, or the launch pad for a 500% breakout? Stick with me, because once we unpack what's really going on, you'll see that silver's fate is far from settled.
Yeah, there's been a ton going on there. As you said, it was whiplash. It was almost like a spook, like when somebody jumps out and scares you, which my kids love to do to me all the time. When you have that surge of adrenaline and your body tightens up and you just kind of react, that's what happened over the last week in the markets, and everything went haywire. People panic. And of course, when they panic, almost everything sells off because they don't know what to do. They just want to get out of positions because they feel like everything is going down. In most cases, most things are going down. If we look at the charts on the SP 500, you can see, we had this big waterfall sell-off going into a Friday on a close, and the weekly chart is actually a really good view of this market. If we look at the SP 500, we closed near the low on a weekly chart, and I was telling people this day after the close, I said, guys, be careful. The market's closed near the lows. Everybody is panicking and freaking out. They're going to have the whole weekend to think about it and build more fear, and it's going to create a gap lower on Monday, a huge sell-off of people just dumping shares, and that'll probably be the washout, kind of a washout low in the market. And the funny thing, Elijah, is this whole window right through here, everybody was saying, buy the dip, buy the dip. This is an opportunity. They're all trying to pick a bottom. And I said, don't go bottom picking, because the market always, has a great way of applying a lot of pain. And then the crazy part is, as soon as the market opened on Monday, everything, the whole script flipped. Media says, we're in a bear market. It's a huge sell-off. Get out of everything. And everybody did. And then the markets rebounded. So this is like signature maximum emotional move in the market. It's a big, just reaction. And now the markets are ready for a bigger bounce. Could last several weeks, maybe even a couple of months. But I do believe the bear market has started. I think the top is in.
The gold-silver ratio isn't just some obscure number tossed around by metals traders. It's a critical signal that's flashing red right now. Historically, whenever this ratio blows out to extremes, silver doesn't just play catch-up, it goes into overdrive. And today, we're sitting at one of the most extreme readings in modern history. For those unfamiliar, the gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, that number is pushing levels we haven't seen since the early 1990s and the peak of the 2008 financial crisis. What happened after those moments? Silver exploded. In 2011, after the ratio dropped from over 80 to below 40, silver surged from under $20 to nearly $50 in less than a year. That kind of reversion is what some analysts believe could happen again, and fast. But here's the twist. Today's macro backdrop is even more volatile. Central banks are navigating a minefield of inflation, trade wars, and rising interest rates. That makes this ratio not just a historical pattern, it's a live wire. The higher it goes, the more distorted the market becomes, and the more potential energy builds behind silver. It's like stretching a rubber band to its limit. When it snaps, it doesn't gently fall back into place. It snaps violently. And that's exactly the kind of setup we're staring at right now. So the question isn't if the ratio will revert, it's when. And when it does, silver could become the most explosive asset on the board.
I don't think so. I think the equities market, we've seen a lot of major topping things happen in the stock market. In fact, the monthly chart of the SP 500, and you and I have touched on this before, Elijah, using Fibonacci extensions, which are one of my favorite tools. They're also, I think, the most powerful tool for trading. If we look at the weekly chart of the SP 500 and we go back to the COVID lows, this is how powerful this is. And we've been talking about this for a long time, that we had this major low in COVID that created this panic, fear-driven move. We had the rally up to 2022. And then we went into this bear market phase and we had a pullback. Now, using Fibonacci extensions, it tells us, based on the previous rally and the strength of the pullback, where the next two upside targets are. So we can carry those targets forward. And if you take a look here, this is the 618 level, this orange line. Typically, if you hit that 618 level and pause, you almost always go up and you hit the 100% measured move. So whatever this move was initially, you're going to see that second move happen again. This is also seen as a bull flag pattern, which is a halfway point. So there's multiple ways to come to the same conclusion. But what's interesting is on this weekly chart, we hit a triple top on the markets on the weekly chart, and we've been clearly rejected at this point. And so this is a very critical turning point in the stock market, saying, okay, I think some damage is done. And what's really interesting is what has happened right here over the last several months is the same thing that actually happened over here. And I have a long-term investing chart of the SP 500 that just shows the overall trend in the market. We need to know, investors need to know when we are in a bullish environment. They need to know when we're in a bearish environment. And of course, we're just coming out of a bullish environment right now. And now we're starting another bear market phase. And this topping phase on this weekly chart of the SP 500 is the same as what happened over here, except for this time around, Elijah, the markets are collapsing all over the place. This is showing way more power in terms of, if you lift the hood to the markets, the motor's about to explode. And I believe it's already kind of had to first time something break. And now it's a matter of just watching this bounce, this bear market bounce. And then I think we're going to be going a whole lot lower. So that's my take on the market. Short term, look for a bounce. Longer term, I think the game is over for a year or two in terms of falling pricing.
The pressure cooker that is today's macroeconomic environment is reaching a boiling point. And silver is feeling every bit of that heat. Panic selling isn't happening in a vacuum. It's being triggered by a tidal wave of tightening conditions across the global financial system. Treasury yields are climbing fast, with the 10-year hovering around 4.3%, signaling not just inflation fears, but a flight to yield over hard assets. At the same time, the US dollar index remains strong near 99.5, crushing silver's appeal in international markets. This isn't just about investor preference. It's about liquidity. When liquidity dries up, margin calls come fast, and traders dump what they can, not what they want. And silver, with its relatively small and volatile market, is often the first to go. Now throw in collapsing confidence in risk assets, falling equities, and a scramble for safe havens, and what you get is a chaotic rotation out of silver, even as gold finds a bid. But here's the trap. These moves are often exaggerated. We've seen it before. During moments of peak fear, silver gets thrown out with everything else, only to come roaring back once the dust settles. That's why this liquidation event is so deceptive. It's not driven by fundamentals, it's driven by fear, by forced selling, by a herd mentality racing toward the exit. But for those watching closely, this is where opportunity begins. Because every crash in silver's past was followed by one thing, a violent rebound. And that rebound usually starts the moment people give up on silver altogether.
Yeah, well, there's a lot of things that kind of play into this. And one of the big things is to take a look over at gold. If we look at the chart of gold, gold tends to come to life right near the end of a major kind of economic cycle, at the end of a stock market cycle. Typically, if both happen together, you get a very big move in gold, which I believe we're having the same type of setup right here. Gold has hit our measured move, our Fibonacci measured move, around this 2750 to 2800. Now, we nailed that. You and I talked about this a long time ago on the weekly charts. Long story short, the Fibonacci targets, just so people can see, is back when gold started a super cycle in early 2000s, put in the top in 2011, the low in 2015. If we carry that forward, we hit this very significant point on the market. We hit the 618 level, which if it pauses, we're going to see that 100% move hit. We've now hit that. And now, Elijah, we're in this blow off phase where now the market is sucking in investors. We're getting closer and closer to a big collapse. And this is when gold tends to shine, and gold miners and silver are coming to life just in the last couple of weeks because of these extremes. Now, we tend to see these blow off phases just before we see gold take a pause or a breather. We had another big blow off phase. It doesn't look like much because this chart has been going up and to the right, but we had another blow off phase just before the 2008 crisis, which was a 34% correction. It might not look like much in the grand scheme of things, but gold had a huge correction back then. So there's a lot of things. Gold is the ultimate global barometer. We just saw the gold-silver ratio spike like 10% in the last week and a half. That when we've seen this happen before, it usually means we're just like weeks away from another big sell-off in the equities markets. We're usually close to another economic downturn of more bad news. The charts lead the economy. Investors are leading, front-running the news that they feel is coming. And so that's where we're at. That's the main thing that I look at right now. But, gold's outperforming, utilities are outperforming, money's flowing out of the Magnificent Seven. If we look at the MAG ETF, which this is the basket of the Magnificent Seven, you can see here, let me just drop to a shorter time frame here. We'll go to the weekly chart. The Magnificent Seven, wherever they go, is going to drag the market with it. And more or less, we have put in a major topping phase. It has broken down and it's trying to find a bottom. It might be putting in a huge head and shoulders formation. It might put in a bit of a bear flag here for, this is a weekly chart, for a few weeks. As I said, the stock market, I think, is going to bounce and trade sideways for a few weeks. So will the Magnificent Seven. And if the Magnificent Seven really break down and break this massive topping pattern, we're going to see a huge bloodbath in the equities market. So wherever the Mag 7 goes.
Geopolitics is now pouring gasoline on an already burning silver market. Just as traders begin to regain their footing, a new shock emerges. President Trump's sudden announcement of tariff exemptions on critical tech imports, immediately followed by an aggressive probe into tariffs on strategic minerals. The result? Chaos. On one hand, the exemptions momentarily ease fears, pushing silver down as global risk sentiment improves. But on the other hand, the tariff probe reignites uncertainty, targeting everything from copper to semiconductors to pharmaceuticals. That's not just noise. It's a direct threat to the supply chains that underpin modern industry. And silver, sitting at the crossroads of technology and finance, is caught dead in the middle. This isn't just a political headline. It's a signal of deeper instability. The exemptions benefit Chinese exports, but the looming investigations threaten to undo that stability in an instant. Markets don't know which direction to trust, and that's where volatility thrives. Silver's safe haven bid is still alive, just buried beneath waves of conflicting narratives. One minute, it's a sell-off on easing tensions. The next, it's a rush to safety as critical mineral tariffs make headlines. This is a powder keg of policy uncertainty, and every time it's lit, silver becomes one of the first assets to react, often in unpredictable, explosive ways. But this volatility is more than just reactionary noise. It's revealing something much bigger, that beneath all the trade posturing and market jitters, the structural forces driving silver are only growing stronger. The market may be panicking, but the fundamentals are quietly building, waiting for the moment when all this short-term chaos resolves into long-term momentum.
It's going to be where the major indices go. And so that's another powerhouse. Gold and then technology, both extreme. One's, a pet rock. The other one is very sophisticated. Both of them are warning us to be aware that trends are changing.
Now, looking back at gold here, what are some of the price points you're looking for if we do see a major pullback here?
Yeah, I think if we see a pullback in gold, let me just, we're on the weekly chart. I'm just going to zoom back a little bit so we can get a bigger, there's a few different ways we could do it. Depends if you want the extreme kind of maximum or you want kind of the more conservative play. But in the grand scheme of things, we can start, we'll start with the start of the last bull market phase. So if we go from here we could see gold pull back to potentially 2,400, maybe even like 21, 2,200, which brings us to this breakout area again. That's a fairly significant pullback. People don't want to hear that. That is a a 34% pullback, which is exactly what happened in 2008. And that's based on Fibonacci patterns. And so this is what I would like to actually see happen, because I do want to load up with more gold. Once there's mass selling and gold pulls back or builds a bull flag, gold may not pull back that far. It might just build a very big launch pad here for the next year or so and then take off. What I believe that the gold space is a little bit overdone. I think a pullback and pause. It doesn't matter where it pulls back. I think this is kind of the max pullback is 2,200. But once it builds a bull flag and then starts to break out and run, that is when it's going to get really exciting, because that's where gold is going to be like 5, 7, 10,000. Miners should take the lead and go ballistic. Silver should go ballistic. So I would expect some type of pause or pullback. We're in kind of that sweet spot where everybody's piling in. It feels like it's FOMO. You're really just buying it because you feel like you're missing out now. That's my take and my technical kind of outlook. If we look at silver, because I'm sure you're going to say, well, let's take a look at silver next. Silver's had a really nice run in the last few days or the last couple of weeks, but it's definitely struggling. And silver's made what I call it 3 surges to a high. And each time it goes up and has a very sharp pullback, that is a sign of volatility. And I believe silver is definitely going to struggle. And I think, everything's going to pull back. And the big question will be, how far does silver pull back once this run kind of comes to an end? And if we just draw a line across these highs that we've recently seen, obviously we're stuck under this blue line, which is a major resistance area from back in 2011 and 2012. So I don't think there's a whole lot of upside left in the precious metal space, which, everybody's really bullish and excited on gold and saying it's starting a massive run. Silver, gold, and miners have all hit their targets. They're all running into resistance, and they're all just in this frothy blow-off phase. So I do feel like they're ready for a bit of a pause or pullback before they want to go higher. And the question is, how big is that pullback going to be? We never really know until...
While panic grips the headlines, silver's industrial engine is still roaring in the background. And this is the part most traders are missing. Beneath the liquidation, beneath the volatility, lies a structural demand story that hasn't slowed down one bit. Silver isn't just a monetary metal, it's the lifeblood of the green energy revolution. Solar panels, electric vehicles, 5G networks, they all run on silver. And here's the kicker. None of these sectors are backing down. In fact, they're accelerating. Governments are doubling down on clean energy mandates, pumping billions into renewable infrastructure. And silver, with no true substitute in high-efficiency tech, is more essential than ever. Right now, industrial consumption accounts for over 50% of global silver demand, and that number is rising. The solar sector alone is expected to consume more silver in the next 5 years than it did in the last 10. And as electric vehicle adoption skyrockets, silver's role becomes even more indispensable. But this isn't just about demand, it's about inelasticity. These industries have to buy silver, no matter what the price is doing. So even as speculators dump their holdings, the industrial machine keeps buying, day in and day out. That's the paradox at play. While the market panics, real-world consumption is quietly draining the supply. And that disconnect can't last forever. Eventually, the fundamentals catch up to the price. And when they do, the rebound isn't just sharp, it's seismic. Because once the selling pressure exhausts itself, silver's industrial backbone will be what drives the next wave. Not speculation, not hype, but pure, unrelenting demand.
Until the market actually does it. And that's just, how it is. Nobody can predict the future. You just have to follow price and then trade the trend that it's going in. And so it's in your favor.
Now, if we look at the gold-silver ratio, it's recently broken out above the 100 level, which is that it's almost never happens. But if we're going to see a pullback in both gold and silver, typically what we see is silver gets hit a bit more. So do you expect that gold-silver ratio to even go higher?
I do. I think it'll continue to go out of whack and push higher. I don't know if this chart will pull up here, but yeah, so I believe like we've seen this big pop in the gold-silver ratio. Now I'm using GLD and SLV, which is kind of like a tenth of the price of things. But overall, we're up into this 10 zone. If we zoom way back in time, as far back as this will go with the ETFs, We're definitely up in a nosebleed territory. I don't trade. I don't make any decisions based on the gold silver ratio myself. I believe it's just a ratio, and I think the key is when the asset you like, whether it's gold or silver, turns a corner and is heading up and it looks like it's ready for a massive run. That's when I'll jump on and trade those and play those moves. I don't rely on the gold silver ratio because it really is just drifting around. So I wouldn't take much into it. I would factor in, look at the big picture of the overall cycles that we're in with the markets, the stages, and then trade metals based around that.
And when it comes to the miners, we've obviously seen a huge move in the miners as gold has increased here in the last few weeks. But it sounds like if gold is going to be pulling back, silver is going to be pulling back. Also, the miners, you're going to be expecting a significant pullback as well, right?
Yeah. So, miners had been declining for quite a while. Then they put in a bottom, and now they're making a series of higher lows and higher highs, which is an uptrend. If we use Fibonacci price patterns, we can look at this first rally that we had and the first significant pullback and carry that forward. And we can see that gold miners in general, this is the large caps, ran up, had the pullback, hit the 618, and then came up and hit that 100% measured move. It had a little bit of a blow off, a little squeeze, which is kind of that last push before it reverses. If we were to fast forward to where we are right now and draw Fibonacci of where gold should go, we go from this low to this rally and down to this low that we saw about a month and a half ago and carry that forward. And as you can see, the 100% measured move isn't far from where gold miners are right now. And in fact, we hit this 618 level. It had a quick bout of selling, which means we're probably going to go up and hit this measured move. And if we look at from where it is, as you and I speaking with GDX at 50.27, it's only about 3 or 4% away. So not a whole lot of upside before it takes a pause. It might pause, it might pull back. I'm not sure. But once we hit these 100% levels, it's kind of all bets are off. That would be your trading target. Pull some money off, put a tight stop in place. Now we need to see what it's going to do. So I believe this is the same with silver miners. They're all coming up into resistance areas. And it's funny because as everything runs into resistance and measured moves, like I'm showing you with Fibonacci, that's right when everybody gets the most excited about gold. Hence the reason it's running up there. The masses kind of pile in always right when it's about to take a pause or a pullback. So that is kind of my take on the precious metal space.
Now let's talk about the one thing no one's pricing in properly. The tightening noose on silver supply. While demand keeps climbing, the production side of this market is limping along and the cracks are getting wider. Global silver output has been flatlining for years, with miners facing higher costs, declining ore grades, and tightening regulations. But the real bottleneck, it's in the refining and delivery pipeline. Just look at the latest good delivery updates. Multiple applications still stuck in pre-application or testing phases, with only a handful making it through to bar settlement. That's not just administrative backlog, that's a symptom of a system struggling to keep up. Add to that the growing complexity of quality standards, changes in bar marking rules, and the recent pause in QR stamp submissions. It's becoming clear the silver supply chain is being stretched in ways the market hasn't fully digested. And while the headlines focus on price action, behind the scenes, refiners are scrambling. Even the LBMA is flagging potential bottlenecks as they race to update guidelines and prevent rejected bars from clogging up the London vault system. This kind of disruption doesn't make for splashy news until it does. Because when physical supply gets squeezed, it doesn't just lead to higher premiums, it forces a reckoning. Traders who thought they could buy metal on the dip suddenly find shortages. Institutions trying to settle contracts face delays. And that's when things get wild. Every silver bull run in history has been amplified by a moment like this, a moment where demand collides with a wall of limited, delayed, or inaccessible supply. And in that moment, the market doesn't just correct, it erupts.
Yeah, so I mean, there's obviously an amazing story for gold to go higher. I mean, there's all to be honest, I think there always has been. Every year it seems like there's a better story for gold to take the lead. And it always feels like it's better than it always has been. And it feels like that now. That being said, last week when we had the whole market scare of everybody dumping shares, gold pulled back like 7-8%. just like that. And that goes to show that when there's mass panic, which a bear market is extended mass panic, we see everything get liquidated. Whether it's a good investment, a solid company, gold, one of the most solid, stable things, it still gets hit. So once we kick over into a full-on bear market with panic selling month after month after month, we have a recession, we have bad news, people just start to dump stuff. So yes, a lot of people are bullish. The story for gold, when I listened to it, I was listening to Peter Schiff earlier. I mean, he paints such an incredible story for gold, and I believe it. But I do believe price trumps everything. I don't want to buy just on fundamentals falling into place. I want to invest and trade gold and assets in general based on technicals. And I feel like it's nosebleed territory. I think a pause or a pullback is what I'm looking for before I want to commit more money. And I'm very excited to get into physical metal. But to me, I already own a bunch of physical metal, and I want to buy it when there's a new launch pad ready to go and it's going to take off, or after a pullback, when I know we're even closer to that sweet spot for another super cycle where gold rallies for 4 or 5 years and becomes that shining star like it is right now. But it'll be the next leg up, it'll be 5,000, 7,000. Who knows where it goes after this?
This is where it all starts to converge. The gold-silver ratio stretched to its limit, industrial demand on fire, and supply chains cracking under the pressure. But the final piece of this explosive puzzle, the short interest. For years, large institutions and bullion banks have quietly built massive short positions in the silver market, using paper contracts to suppress prices and control volatility. But that game only works as long as confidence holds. And right now, that confidence is beginning to fracture. When traders start rushing for the exits and physical supply gets tight, the shorts find themselves in a dangerous position. They have to cover, and quickly. And when they do, it creates a self-reinforcing feedback loop. Each buy to cover drives the price higher, which triggers more covering, which sends the price into a vertical spiral. It's exactly what we saw in 2021 when a Reddit-fueled wave of retail buyers briefly triggered a run on physical silver. That attempt was cut short, but the blueprint remains. The setup is even better now, because this time, it's not just retail sentiment driving the trade. It's macro fundamentals, supply shortages, and a historically overextended gold-silver ratio, all pushing in the same direction. This is how silver moves. It's not steady, it's not polite, it's slingshots. And when the short squeeze hits at the same time that the physical market runs dry, we're not talking about a 10 or 20% move. We're talking about silver doing what it's done in every past cycle, gaining hundreds of percent in a flash. And for those positioned correctly, that's where generational gains are made.
Yeah, for sure. Yeah. It's easy to get caught up, when you hear the fundamentals and the stories for all kinds of different assets. It's really easy to make you want to buy in and get excited about it. But if you can cut the emotions out and just look at the markets and every asset like it's trying to take your money, why don't you just wait until it has like a strong pattern and it's starting the next rally and get on board versus kind of jumping on ship, after it's had a big run and it's ready for a little bit of a pause. No, I think we kind of nailed it. I think everybody just be prepared for extreme volatility, probably lots more wild news. And we are in a sweet spot for precious metals. I wouldn't be surprised if they keep grinding higher. But again, I don't think there's a whole lot of upside potential when it comes to gold or silver. And just be aware, if you're a long-term holder, well, you're going to probably hold through some drawdowns for a while. Could be months or a year before we go higher versus stepping aside when it does start to roll over and rebuying things at, I think, a more fair value from a technical standpoint.
This moment in the silver market isn't just another cycle. It's the collision point of everything we've laid out. A gold-silver ratio at record highs, panic-driven liquidations, explosive industrial demand, a tightening physical pipeline, and a short interest just waiting to be squeezed. Each force on its own could move the market, but together, they're setting the stage for one of the most violent price reversals silver has ever seen. Whether we see a final flush out or silver catches fire tomorrow, the setup is undeniable. History shows us that silver doesn't warn when it moves. It erupts. And when it does, it punishes the complacent and rewards the prepared. If you've been watching the signs, tracking the ratio, reading the delivery reports, paying attention to the political chaos, then you know this isn't random. This is the moment silver does what it's always done when ignored and underestimated. it rockets higher, fast. So whether you're bracing for more pain or preparing for liftoff, understand one thing. The window of cheap silver is closing, and once it breaks, it won't come back. If you want to stay ahead of this market, make sure to subscribe so you don't miss what's coming next. And remember, this is not financial advice. Always do your own research and speak to a licensed professional before making any investment decisions.